Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today we welcome Kane McGukin. Kane is in the traditional wealth management space. He's been writing about Bitcoin for several years. Kane, welcome to the show.
Nick, thanks for having me. I appreciate you having me on today and look forward to our discussion.
Absolutely. Kane, we brought you on. We want to talk to you about Bitcoin, but I brought you on to discuss financial warfare. You and I discuss the Eurodollar system from time to time. We've been looking at it for several years, but now it's all of a sudden at the center stage. And that Eurodollar system at the center stage has a couple of interested parties, the United States and elsewhere. So why don't you set the stage for us? Why are we here today to talk about financial warfare? What is the point you want to get across to the viewers and the listeners to understand where we are today in the financial system?
Perfect. So for me, it really has happened across maybe 10 or 15 years. So I got into the business in 2006. Shortly after was 2007 and 8. And as a part of that process and being young and not understanding exactly what was going on, I just dove into balance sheets of big banks, seeing who was getting paired off, started coming across terms that I didn't understand, Eurodollars, credit default swaps, all of those things. And the tick balance sheet or balance sheets and then the tick reports for commodities and a lot of that stuff. So I spent a lot of time really stepping backwards, studying a lot of guys like Paul Tudor Jones and all of that. And that led me down this path of what eventually came to just start looking at Eurodollars a little bit and more understanding the markets as a fund flow system rather than just you got stock markets, bond markets, commodities markets, and seeing how different portfolio managers focus on different areas, but then they would make different decisions based on how they were allocated, based on where expected funds were to flow. And so that was really how I got started into what is really, and it still is today, a difficult arena.
The United States now has a strategic Bitcoin reserve. That's not speculation, it's policy. Unchained and the Bitcoin Policy Institute have put out a new brief, and they have an online event coming up on June 3rd. This brief breaks down the first 100 days of executive policy action on the strategic Bitcoin reserve front and broadly on digital assets. It's an excellent brief, and make sure you go download that brief and sign up for their live event at unchained.com/TBL. It's on June 3rd, unchained.com/TBL. The Financial Freedom Report is a free weekly newsletter from the Human Rights Foundation. It tracks how authoritarian regimes are weaponizing money to control their populations and suppress dissent. It also spotlights how technologies like Bitcoin are helping everyday people reclaim their financial independence and freedom. A one-of-a-kind newsletter connecting the dots between financial repression, geopolitics, and emerging technology. Smart macro analysts don't just watch the Fed, they watch the world. Go to financialfreedomreport.org to sign up for the free newsletter. And the flow of funds investment thesis, is one that we subscribe to. We are researching. People will be familiar with Michael Howell and his liquidity framework. He cites the Henry Kaufman, Solomon Brothers days. And what we learned from Solomon Brothers and the offshoot of investors since then is that they looked at how money was moving across borders and from asset class to asset class. And through that, they were able to invest and outperform because they were following the money, not looking at what are the underlying investment fundamentals typically that we use, such as earnings or inflation for that matter. They're looking at flow of funds. So thank you for setting the stage. Now get into the bank balance sheets. What did you see there? What did you learn about Eurodollars? What were maybe your first few learning lessons? And Kane, why don't I remind you and the viewer that people don't understand the Eurodollar broadly. And so each episode that we do on it is an opportunity to explain it from 101. I did an episode recently on my conversation with Grok on the Chinese involvement in the Eurodollar system, and I gave people a 101, and they said, "Wow, this was the best one because up until now I haven't been able to understand the Eurodollar system." Or recently I had a reader say, "I just finished Bitcoin age. I finally understand the Eurodollar system after so long." So why don't you take your shot here? What was your learning process with what is this Eurodollar system, and what did you see to teach you that?
Yeah, so it pretty much, in very simple terms, you take a capital stack, whatever it may be, and then you create yield on it. And so financial markets, they work off a yield curve, and then every once in a while an asset class comes along. So if we had dollars that were created in the 40s in the dollar basket, that was kind of like a new asset class. And so that capital was used in one market, but other markets wanted access to it and they couldn't get access to it. But those dollars would sit in international banks or in European banks, non-US banks outside of the system. They technically had to follow by dollar rules, but they circumvented it by saying, hey, we'll let the dollars sit here. We won't actually use them, but we'll create another benchmark rate on top of it, which is effectively Eurodollars, Libor, that whole system, the system we all know. So financial markets are really just a history of taking new collateral assets and securitizing them in ways to create different yield curves on top of something that's commonly accepted as money or money good. So that was something I learned over time. But early on, what really kind of led that was the pairing off of Bear Stearns and JP Morgan. So I originally started at Bear Stearns. Shortly after, went to another firm, and that obviously I had an interest in what happened with Bear Stearns and seeing them go down and being one of the Wall Street behemoths. I started looking through, well, why did, when they had the meeting where the major 8 or 10 banks showed up and put money in the table and said, we'll put this much into the system to backstop it, and ultimately Buffett was a part of that, but why did the Fed and the government pick JP Morgan over somebody else to get Bear? And the same thing for Wells Fargo and Bank of America. Wachovia, I think they just let go under. Why did that happen? And so when you looked through their balance sheet, you saw all these different structures and SPVs and all these different things that nobody ever talked about. But what more importantly, what I thought I saw, at least, I could be wrong, but you had a big player on one side of a CDS trade and another big player on the other side. And when you have a trade like that, and at the time they're like, well, we're going to go to court and you owe me this, and I don't think I owe you that because I don't agree with what you mean by default. So if you take the two largest players and you put them together, there is no trade because one firm owns both sides of the trade. So that was one thing that just kept leading deeper and deeper, and then it eventually led to Libor and Eurodollars, and I forgot when the Libor scandal broke, but there were talks of it early on. And then I'm sitting here thinking, well, what is Libor? Why is it important? And that's what kind of got me there. A little bit a long-winded answer. Hopefully the earlier part of simplifying it down helped.
Yeah, absolutely. Now let's fast forward right to the financial war. Where are we today, and how does the Eurodollar play a role? Or why don't you explain what are the sides in the financial war, and we can go from there.
Sure. So if you think about money as just liquidity, and for the world to work, liquidity is required. So you get the Austrian camp that says we should never lever anything, just simplifying it. And then you got the MMT crowd that says we should lever anything and everything. And both of those alone don't work. Somewhere in the middle, they work. So you can have credit's fine. But once you step into the leverage bucket, you get into issues. If you're all in the leverage bucket and don't just have credit that gets paid down, you get into issues. So when you think about the world in terms of liquidity and how it needs to flow, you start to see that, okay, Bitcoin is just the next liquidity tool. It restarts money from a sound money basis, from a sound money core, but it keeps that liquidity going. There's too much liquidity in the system. Some of that liquidity will come back to Bitcoin because of the sound money principles. But when you look and say, okay, well, what's going on in the world? We've got geopolitical, wars and battles. So you got nations at each other's throats, and a smaller nation wants to be a number one, an older nation is just trying to hold on to number one. So you've got the U.S. on one side, China on one side, you've got Russia, you've got a number of different countries battling, similar to how they were in the 1920s and 40s. You've got money that's creating new ways to deliver liquidity to people at the rate with which the speed that we move around the world works. That was like the early 1900s when we were kind of figuring out central banking. And then you've got inflation and deflation like the 60s and 70s. So all those things happened across 4 decades, and we're now having them in 5 years. So when you get paradigm shifts, the world changes, you generally have turmoil and chaos. And so if you look at the financial plumbing and how the relationships in markets are changing, treasury rates are just going all over the place. The volatility in the different asset classes is very unusual. And to me, that speaks to financial warfare where different countries are jockeying for their position, not in the normal way that, is bad for people and death and destruction, but more of an economic destruction that's less visible and maybe doesn't hurt as many people.
So what do they do? And by they, I mean the people outside the United States jockeying for position. And you say that, and I'm a big proponent of this, where you look at the prices and the way that the prices are moving, and you can make some determinations from that. How do we prove it? What are they doing? What are these acts of financial warfare that are coming from abroad? And then maybe you can tie it back in with what is the U.S. doing to defend itself?
So, yeah, let's just take treasuries, for instance. That was another thing. Looking back at balance sheets and whatnot in 2007, it was thought that, hey, international players, international banks, all the international players are buying MBS, CMBS, CDOs, all the junk. And the US banks were selling it. Hey, it's not our problem. We're selling it to somebody else. They'll have to deal with it. But when you went back and looked at the flows, you could see that it was actually just hedge funds that were, a lot of them US, that were domiciled internationally, as it would show up in the data. So if you think about it from that light, we got that wrong, and it caused a big issue. And you look at treasuries, the treasury market's the deepest in the world. That's how most of the lending in one way or another gets pegged off Fed funds rates and Libor rates. And you think about, okay, if all of these countries own the US debt and we're just issuing new debt to pay for our own users, the US citizens, to buy cheaper goods, to, have a better lifestyle than the rest of the countries, then that sort of makes the rest of the world angry. And as you can see in 2015 or 16, a lot of the countries started selling that debt. So they're getting out. The US is kind of stuck because we're addicted to all the consumption and all the positive that comes with the way that it's set up. So now all of a sudden we have to find new buyers. And a lot of those buyers, like for instance, I think I read where China has a lot of its treasuries held in Turkey or something like that. So it may not just be in China. So on the data reporting, it would actually look like Turkey was a seller when it was really China, or, other countries may be the same way. So then we've lost our buyer that supports everything that we kind of live off of as the consumption economy. So that presents a problem for us. So now we have to find new buyers for that, which we've sort of done with stablecoins. And so I'll kind of stop right there. If you've got any questions, you want to jump in, and then we can go a little bit further.
I want to talk about stablecoins shortly. Now, let's talk about what we're learning over the past few days, which is somewhat of a bait and switch from the current administration. We're going to cut. No, we're not really going to cut spending, and the deficit is going to stay where it is or potentially even expand. What are your thoughts on the sustainability, what happens to the bond market, term premium, the shape of the yield curve, nominal rates broadly, real rates, all of these things. Not just put your rates hat on for a few minutes, and then we'll come back to the geopolitical financial warfare that we've been discussing.
So I think on the short end, we short-sightedly look at this president or that president without realizing that most of where we are in life, regardless of what it is because of our decisions and choices for years that compounded upon each other. So whether we had Trump as president or Harris as president, it wouldn't really matter because their decisions, the choices they have to make, are bound by the decisions made for the last 50 years. And those compounded to a point where they're exponentially out of control. So that deficit probably stays, right? Because we have to continue to put liquidity in the system because that's the only way our current political parties understand how to operate, financially. It's not a good thing. I mean, I think Doge, you could maybe think is bad, but it's good to cut spending just like you would in a household budget. So from that perspective, we're probably stuck, which is good for Bitcoin. If you talk about rates specifically, I found a chart couple of weeks ago, a month ago, and it was 220 years of interest rates. The most interesting thing about that chart is assuming that the data 100 years ago plus 200 years ago is correct. The broad range that interest rates normally happen in is 6 to 9%. It is abnormal for rates to be below 4%. And most of our lifetimes, we've rarely seen over 6. So Milton Friedman, I think, says, high rates are a sign of a functioning market, low rates are a sign of a non-functioning market. So our entire careers, most of the professionals in the space only understand how to operate in an environment that is abnormal. And to me, that's why it's so important to think about, well, who's, running the Treasury now with Scott Bessent. Why? Why is that important? Because he's a hedge fund manager. So he understands the correlation of the intermarket assets and how they should relate and function to one another, and would be able to see when changes in those relationships happen, which could tell you in a financial war when assets prices are being used that something that we didn't see is going on, or something that we are doing is actually working to maintain our pole position in the global economy.
Can you give us a specific example of that? Because I think that's a fantastic point. Bessent is a hedge fund manager. He's of the Druckenmiller Soros school. He tells stories about his days on the desk as a rates analyst, as a cross asset analyst, someone that watches flow of funds. He's discussed all these things. So give us a practical example, either something that's happened here in the first 4 months of the administration, or something that you anticipate could happen this or next year in the financial markets. What specifically is he looking at and trying to relay to either the president or maybe the populace itself?
The biggest thing, they said maybe 2 months ago, we're going to focus very hard on the 10-year yield. They're going to try to pull that down. They did. It's back up. But if you look at how the dollar reacted, the dollar over that period was going down very hard. Typically, that has been Bitcoin rip. Bitcoin did not rip until dollar got right down to support. Then it started ripping. The same thing. The only thing that ripped really was international. So that's kind of normal. Dollar down, international up. So if you think about it simplistically, where we have been for the last 5 years is dollar up, risk assets down, dollar down, risk assets up. And in this environment, it's inflationary. So bonds and stocks have actually gone the same direction, which didn't really happen before 2000. So I think the focus on the 10-year, bringing that down, because that's the only way policymakers, hedge funds, market participants know how to work. So he's got to work within that one bound. But then the other bound is applying yield curve control, but not across rates, across dollar, rates, equities, fixed income, and digital assets. Because digital assets is the lever that you can bring liquidity in, you can grow it, which will alleviate some of these. So taking that same knowledge of how you maintain a yield curve, and then instead of doing it across that one thing, fixed income, doing it across all 5 of those assets. So I don't know that's what he's doing, but that's what the charts look like he's doing.
Now explain that. So you're talking about yield curve control across multiple assets. So break that down for us. What does that mean?
So in February 2020, the New York Fed put out a paper signaling to me that yield curve control was what they were going to do. And they said, this is what we did from 1942 to 47. And so you buy one end, sell the other, but really you're kind of pegging the middle to not let anything get too far away from the 10. So you saw that post that paper, February 2020, to the first couple of years in the 1 and 2 year. So you could buy 1 and 2 year at 1.5%, 2.5%, eventually got to 4, and then it got to 5. When the long end spiked up to 5, which now I think is like 5.13 or so, they sort of pumped the brakes and reverse course to hold that yield steady. So if you're buying bonds, you're pushing the rate down, and then selling the other end. So you'll see that rate come down because you're selling it. So there's a balance there. But when you look at over the last couple of years, I just follow those 5 markets. When you look at the relationships and how they sync up, they've been air quote abnormal. But if you went back and looked before 2000, they've kind of paired up to how they did then. And then periodically on a 6 or 8 month window, so let's just say we were dollars up, risk assets down, that worked for about 24 months from 2021 or 2020, 2021 to about 2022 or 3. And then it changed. And so instead of Bitcoin and dollar going opposite of each other, they started pairing, going together. Does that help?
Well, I want to ask you about yield curve control with asset classes relative to each other. So when equities perform well, or let's anchor ourselves in the 10-year. So when the 10-year comes down in terms of yield, that means the Treasury asset class is doing well. What are policymakers looking for from equities in that environment? Or what is he trying to do to other asset classes by bringing yields lower?
So what I think is going on, this is just my personal opinion, it's less about just the asset class, but also about how to maintain an organized society so everybody's not going crazy because things aren't getting shipped with the supply lines. You're not getting super inflationary prices at the pump and at food. So when markets rip, so if equities are running, and this comes to my side of the world, then clients generally feel great. If they want to go buy a second house, they're going to do a big trip, they're going to do these things. But if equities compress and fall significantly, then they hunker down, they don't spend. So if there's no spending, then Target, Walmart, McDonald's, the core companies aren't making revenue, which leads to the recessionary environments, layoffs. So I think in a simple term is like, how do we balance this for the citizens? Because if we come out, you and I had talked about, if we come out and say, hey, we're at financial war with China or with Russia or with whomever, the people would just hunker down and not do anything or go anywhere. And when that liquidity function of people spending their paycheck stops, it hurts all 5 assets. So you have to push them around, if you will, one way or another to maintain balance while allowing some to win. So players focused on that segment win for a little bit and then pull back the liquidity from there and push it to a different asset class to make the other assets work. Does that make sense?
Yeah, it does. Now let's talk about the Eurodollar. Now, what's the Eurodollar's role in the evolution towards SOFR and a couple of the policy moves that I see as very likely are to support the Treasury asset class. Number one, SLR reform. Now Besant says this summer it'll come, meaning a relief for capital charge for holding treasuries. That's an onshore regulation. And then for offshore, the ECB is warning its member banks that they might not have access to dollars via the Fed swap line. And I believe that's one way of them communicating that they've been warned that if you do want dollar liquidity, you're going to have to pledge Treasury collateral against it to secure it. That's not something that I've seen discussed broadly. But the fact that the European Central Bank is warning its member banks they might not have access to swap lines is a well-known story. So, what are your thoughts on that, and how are you thinking about the Eurodollar system and how the U.S. policymakers are treating Europe?
So interesting thing there about pledge collateral. If we step back just a second into the past, if banks have to pledge treasuries and they don't own them, what do they have to do? They have to go buy them. So I'm doing yield curve control across different asset classes. I'm going to take the asset that I know people are trying to get out of, and I'm going to create reasons that they have to buy that asset. So that helps us on that end. What really, there were two things that really stuck out. I think it was 2020 when in the depths of 2020, we opened swap lines to 9 other countries through the Fed, which was kind of abnormal. We have a couple, but that was a big sign that there were problems in the liquidity channels that were underneath the surface but not seen. And the only reason why you would make those is if you wanted those countries, obviously, to support them, but you wanted them to be on your side. Secondly, I think it was 2022, Jack Mallers' final on-stage presentation of Strike. And he said, basically, we're going to put dollars on the Bitcoin network and push those back and forth. And I thought to myself, well, that's awesome, but that's not in Satoshi's vision. It was not meant to be levered, so to speak. And if you do that, then the holders of the Bitcoin are what becomes important, and not from a company standpoint. So the more Bitcoin you can amass, kind of like what Saylor's doing, becomes more important than the individual users. We would still have optionality, and the value of that would grow as more companies grow. But really, in that light, all you're doing is rebuilding the commercial banking system of the 1980s. So if you take that forward, what was Eurodollars? It was just a liquidity function for international players or anyone not wanting to play by the US rules. And so at that time, I'd always thought early on, 2017, 18, that stablecoins were Eurodollars 2.0. And so in 2022, I wrote this article for Bitcoin Magazine that you could tell something in the system was about to break because the Eurodollar market was not functioning correctly. And when you went back and looked, you could see every time it kind of functioned like that, something major broke. Well, what ended up breaking 2 or 3 months later was FTX, which then effectively almost took down the regional banks and others who had made basic bad bond decisions, kind of 101, don't buy long dated bonds at a 1% yield, because they just didn't think rates would rise because they're operating under this 40 years of rates collapsing. So what I realized I got wrong partly stems from some of the stuff you laid out in Layered Money, where eventually Bitcoin becomes at the top of the triangle, where it's just a balance sheet asset, just like gold, treasuries, and some of the other stuff. That was clear. But there was a Gold, Goat, and Guns, I think Tom Longo and Caitlin Long, about a month ago. And what I missed was I thought SOFR was just a manipulation tactic so that banks could do the same thing they did, but from a higher basis than Libor. So they go through it, and he says, no, SOFR, in his opinion, was a reset of a banking system so that everybody on Libors and Eurodollars is unsecured risk. And everybody on SOFR, and now if you're looking at BIT bonds potentially being in treasuries and all these other relationships to Bitcoin and stable coins basically acting like a dollar basket around Bitcoin, then everybody on the SOFR side is secured collateral. And so if I'm in a financial war, do I want unsecured collateral or do I want secured collateral? And I'm taking the secured side. So that's, to me where one thing, if that's true, what I missed was why SOFR was reset. And then that kind of brought me back to the Eurodollar environment and why that was important. It's really just understanding that from a risk perspective, while you may be able to make a lot of money in kind of degenerate crypto land, you're better off in a secured Bitcoin land than an unsecured Eurodollar land. So adversaries that choose to not be on the US side typically would sit on either a yuan trade, which is the Belt and Roads Initiative, or a Libor focused entity. I know Libor has gone away, but on the unsecured credit side rather than with the US side.
And people should definitely go listen to that episode with Tom Luongo and Caitlin Long. It was fantastic. We cited it in an episode recently. And I think what's interesting to me, Kane, I want to share this with you and the viewers and listeners. I had a thought just yesterday. I wrote about it for the TBL Pros in my letter that went out last night, that I'm actually starting to see the world a little bit through these SOFR colored glasses. And through the SOFR colored glasses, I saw the move over the last 48 hours to abandon fiscal discipline, hit the market with as many bills as they need to, not terming out the issuance, which they have been steadfast on. We are not going to increase the size of 10, 20, and 30-year coupons. Therefore, all deficit spending gets done in the bill part of the curve. And then with my SOFR colored glasses and my money market trader, repo trader hat on, which is where I come from, I remember that when you're trading repo, you're not just a repo trader. You're a repo and bills trader. It means that at any time, if you have cash, and I as the fiduciary for institutional capital, needing to make sure, number one, I preserve the capital. Number two, if they need it tomorrow, they can get it without penalty. Meaning I cannot take bid-ask risk, undue bid-ask risk. Therefore, I cannot own securities beyond the point that I feel my client might need liquidity. And my client doesn't even know today what they'll need tomorrow. If they did, they might email me that information, but most of the time they don't. For that reason, I need to have X amount of my portfolio always ready to go the next morning. And so I have to make sure I'm allocated to overnight repo to that degree. And then the next bucket is really short treasury bills, because on those I do not fear a bid-ask penalty, or mathematically it's so small that cash is cash and I can just liquidate it for essentially the price on the screen. Anything else I hold in my portfolio, I'm really just going for it because I want to pick up that extra yield, because I don't want to keep my entire portfolio in SOFR overnight, because it's not enough yield to make my client not fire me. They're actually hiring me so that I can out yield money market funds, which by law are mandated to hold, I believe it's 25% in 7-day or less liquidity. It's the law. And go ahead, Kane. Would you want to?
Well, what's interesting there, not to cut you off, that's exactly my philosophy on how I try to manage people's portfolio. Same premise. There's a certain amount of cash you have to have because you spend. Keep that in your checking account. I don't need you to come ask for money, right? There will be times, and let's make sure that bucket. Then there's a certain amount of money in these 5 years where you don't need fixed income because you're getting paid 65, 70% of the 100-year fixed income rate in 2 years and under. When the curve changes, we might go 3. We're not really going out that far, but generally we're staying at 1 and 2 because based on issuance, they're incentivizing you to buy that over the long end. At some point, duration will make sense. We've been in that area a couple of times. We may take some shots, but generally speaking, not yet, because of this financial war that nobody can figure out how far we're in, or how long it could go. And then on the equity side, it's equities. And then you have the Bitcoin and gold, because it's an inflationary environment. The only way out is to own inflationary asset, or assets that work with inflation.
Yeah, absolutely. Now, I want to talk to you about stablecoins and gold, but let me finish my example here from the money market trader standpoint. That when now the market is going to get hit, meaning oncoming supply of more treasury bills, what it does to the money market trader is the money market trader goes out to the market and sees the yield on short bills being attractive now relative to repo, because there are more of them. And the Treasury needs to provide incentive to investors to fund itself. And it does that with yield. Dealers attract funding by offering overnight liquidity, but the yield has to be competitive. If it's not, then they're not going to get the funding. The funding will go to the Treasury. Now, what happens in an environment when the market is hit with a ton of liquidity? Bill yields go above repo yields. There is no reverse repo facility to draw down from to get money into the bill market. It's not a one for one. It's coming out of reverse repo at the Fed and it's going into bills. Now it's going to come out of regular repo, overnight repo, dealer repo, and guess what? Probably some Eurodollar deposits that are getting X amount of yield. Well, now the Treasury is offering a higher yield than some of your Eurodollar deposits or your commercial paper or your CDs. And if that is the case, I'm going to go into bills. So I had this, and this is a credit to Tom, which is that now I'm seeing it with the financial warfare attack on the Eurodollar perspective. And I didn't even, it's interesting to me because up until the last few days, you didn't know you were being bait and switched by Musk, et cetera, right? They just are finally admitting that. Oh, just kidding.
Well, it's. I had somebody tell me they were a developer for one of the big banks in 2018 or 19, Trump's first term, when they were going to just delist all the Chinese companies, and so all those holdings just got annihilated. And they said, message came down from the desk, we've got to get these off our books. Some of the traders, my clients, are going to take huge losses. And the answer was, it doesn't matter. This is war. And when war happens, people get hurt. And so that was kind of eye opening, because you don't really think about that. It happens, but you don't really think of it from that perspective in financial markets. So that sort of refed into an old thesis that I had. And then seeing the different things go on with Bitcoin, the things that it allows, that the Bitcoin network, crypto networks, what it allows other countries to do is get out from underneath the IMF and the dollar thumb. So in my opinion, the best thing some of those countries could have done was to go to the Bitcoin standard, use crypto rails where they could, because they have control over those rates and decisions, where they're not a price maker in the US dollar system. They're a price taker, whatever it is in terms of loans and whatnot. And so if you think about, this was an epiphany off the back of listening to that about a month ago. So if I gave you a choice, you want a gold backed system that also has Bitcoin access and has a structure where stable coins are pegged around Bitcoin, very much like the US dollar basket. That's option one with SOFR. Or you go to the other system where there's no gold backing. You have US Treasury backing, which is backed by deficits, and a fiat basket around US dollar, which is not actually a thing. It's just the opposite of the 15, 16 currencies that make it up. And that's with unsecured debt, with old LIBOR debt that's still in the system. It's not quoted on LIBOR, but the old levered system. Which one do you want?
Now, Kane, it's hard for me sometimes to see the mechanisms by which the U.S. is trying to revalue gold higher to address some of this re-anchoring that you're discussing here. Can you explain it for us? How is it happening? What are you seeing in gold? How is the U.S. thinking about this? What is there evidence? What's the evidence that China is doing it as well? Can you walk us through some of that?
The big signal for me on that front, and admittedly, I don't know it as well, and I never was a gold bug. I was always aware of it. I don't know it as well. But the biggest eye opener for me, I think it was 2016, might have been 2017. Trump was going out and he said, I'm buying all the gold I can buy. At the same, and this was in headline newspapers. At the same time, Putin was saying the same thing. At the same time, China had quit buying treasuries and they were doing the same thing. And so I'm looking around, well, why is the rest of the market not paying attention to this? Because it seems like a big deal. And so that tells, and then 18, 19, we had the repo spikes, which, so you had big, and Trump not being a big player, but he was in the political realm at that point. You had big players, Russia, Putin, and China buying gold. You had other investors buying gold, and then you had bottlenecks in the liquidity system. So that was a big play, and so I think if you look at what Yellen did and drew down TGA, I'm not a big follower of TGA, but enough to kind of see how it flows. So she drew it down. That was the thing that could help the government with the repo and kind of get them out of trouble. So the only option, if you take a markets guy, a Basent guy, and you hear all this chatter from primarily gold bugs that, hey, they're going to revalue gold to fund the TGA because the U.S. has a big stockpile of gold and they can use that asset. So the other big thing that Basent said in one of the early speeches, this is the one I forgot earlier when you asked me, but we're going to strategically divest of U.S. assets that don't really do anything. They're just effectively dead assets and reinvest proceeds from where we do sell into Bitcoin. That's a big move. But like, to me, gold is not a dead asset. It's the only money to last throughout mankind. But if you can come up with creative ways to make the market revalue gold and not have to do it yourself and repeg, because when I told you got this gold Bitcoin system, if you come out tomorrow and Trump Basent say, we're going to go and the official stated rate for gold per dollar is $1,000 or $500, and they've got it on the books at 25 or 30, who does that give a haircut to? Everybody. But most importantly, it gives a haircut to people that for the last 30 years have built their wealth on leverage. More so than people that maybe don't have a lot of financial assets, your typical average American, and doesn't have access to gold. So I think the same way that Bernanke and all those guys used to Eurodollar University, to use Jeff's point, where they tell the market what they're going to do and then they don't actually do it. They let the market do it themselves. I feel like if you look at gold, I mean, obviously it's acting this way because we're under financial stress, but if you look at gold, is that possibly the play so nobody has to actually come out and revalue it?
And now when the gold price goes up like that, what is the impact on China? Because we think about the Chinese gold stock, does it potentially strengthen their position? And is that the way that we can think of it too? And is that part of the way that the world adjusts to this new order, is that we get higher gold prices just as a necessary condition?
If I have seen some research, and I haven't read deeply, but where it does benefit China, and especially if you think about it, if they were buying gold much earlier than we were in the 2014, 15, 16 era, maybe they don't have as big a stack. But now the one thing that gold gives you is staying power, right? Because there's always somebody in the market that will take it. It has value forever. You may not get the price that you want, but gives you staying power. So it definitely gives them a benefit. And if you look at what Dalio says, Dalio has pointed out, I think in the back of his New World Order, and he said it, China doesn't really want to be number one in the world and be responsible for taking care of each other and step into Triffin's dilemma. They just want a seat at the table and not be treated as just the maker of things and, oh, we'll give you your cheese when we decide to give it to you. So I think for China, by buying up gold and then ensuring that your gold price has a premium so other people around the world come to your market as opposed to the US, plays out in their favor.
And maybe you've already answered this throughout the interview already in parts, but how does the U.S. escape the Triffin dilemma going forward?
That's where I think the Bitcoin stablecoin piece. So if you
unpack
start
that for people.
Because Triffin's dilemma basically, in simple terms, says at some point you either have to choose to support the world over your people, or you have to support your people over the world. And if 2020 to 2022 taught us anything, it was the US having to face that real decision. And they've sort of at different times, we supported the world. Now we're kind of pulling back and we're saying we're going to support our own people. And it's a tough road because somebody on either side of the fence is mad. And that's kind of where we are. So I think the only way out is to reestablish a set of financial rules and then start the game over again, start from a sound money asset. So if you can re-embed gold without specifically saying this is the new price of gold and everything get rebased on that, and allow those, this is again the yield curve control across assets, and allow the asset classes to adjust out over say 10 or 15 years, then you do Dalio's point where you don't have physical conflict. And so you avoid the typical war with missiles and guns and planes and all that thing. And if you reset a new set of financial rails on a sound money asset, now you have two sets of rails. If you want to go to Vegas and do the Vegas stuff, you can do that. It's in the traditional fiat 180 global currencies treasury system. If you want to play by sound money rules that build lasting wealth, then you're going to do it in the gold, Bitcoin, stablecoin world, which is effectively, if you look at all parts of it, not a single part of that new system with stablecoins and Bitcoin and gold and all those tools are any different than a dollar basket, a Swift transaction, an ACH, or any of that. But it re-gives stability and allows to set a new set of owners of the currency, control of the currency.
Now, let me ask you to repeat that answer. And now we've let the word leverage into it, if you can. Mm-hmm. So just restate that for people, but use leverage, the word leverage, to describe it.
Yeah, so the old system, the fiat system, is where all of the leverage sits. So you can still have all that leverage, but then you have the sound system, which is the Bitcoin stablecoin side, that sits to the side. We have bridges going across, so we can port some of that leverage over if needed. But with Bitcoin, the advantage is that because everything is traceable, trackable, you can see the leverage real time. So remember early on, I was talking about Austrian and the MMT. Well, if Bitcoin sits in the middle and you have credit, which is Bitcoin stablecoin that you can see on nodes, anybody can pull it down. I know if Goldman Sachs says, I don't have any leverage, I just look at their node and they don't have leverage, or let's say River. But in the dollar-based world, the leverage side, the right side that goes towards MMT, you have Goldman Sachs says, hey, you should trust me. I've been around 200 years. We're money good. JP Morgan says the same thing. And then you end up in a Bear Stearns scenario because the leverage is 40 to 1 or 50 to 1. And so the important thing is now we have a monetary unit that sits in the middle that can allow us to play in credit, allow us to smartly play in leverage. So I know if I want to take that risk, I might get a 0. But if I do it over here, I can always know. Is that where you were going with the leverage? Or
it is, and it makes me think about layered money a lot. Because when I wrote the book, it was an academic pursuit. It was in part a prediction, Kane, but you have to understand, and I hope people do understand, the predictive aspect of it was merely an exercise. It wasn't me trying to say, hey, Bitcoin is going to be king of the world, and here's an academic thesis behind it. It was more empirical, and I just had a moment that resonated with what you just said. I want to leave it there so that people can respond to what they've heard today. I think they're going to learn a lot, but then also have a lot of questions about what do we need to unpack here, because you've presented a lot of aspects of this, Kane, from financial warfare to leverage to the credit system to Bitcoin to gold, deep history. When you said it's the oldest money in all of mankind, that's an important detail that people cannot forget when they're thinking about this. Yet it's nowhere part of the current discussion when we think about the reordering of the world. So, Kane McGukin, we appreciate your time. Thank you for joining us today at the Bitcoin Layer. Tell people where they can read your excellent writing.
Yeah, Nick, first off, thanks for having me on, and congrats to you for Layered Money. It was a great book. I enjoyed it. The new one I haven't got to yet, but I know it's good. Where people can find me, I'm on Twitter, just my name, Kane McGukin, and I write on Substack from time to time. And I also run Navigating Bitcoin's Noise, which is just a podcast, have conversations like these. And I've slowed down in terms of I'm not every week, every 2 weeks, because I like to think about things that matter, and I like to stay out more so of the narratives unless I'm trying to say this is right because, or hey, this is probably just a fad narrative. And if you really want to practice sound money and build wealth slowly, that we should probably just kind of let that one go by the wayside. So Twitter or X, Kane McGukin, and then Substack under the mesh point.
Kane McGukin, thank you for joining us. I'm Nick Bhatia. We'll catch you guys next time.
Thanks.